We find ourselves in an environment with great uncertainty. Today's event is designed to provide multiple perspectives on what the future holds and what factors to consider as you make business decisions. Our speakers have been selected to prompt your thinking as you guide your companies into the future. Our first speaker is Eric Willett. Eric is CBRE's Director of Research and Thought Leadership for the Pacific Southwest Division, where he oversees the region's delivery of forward-looking insights spanning all major property sectors. His innovative research describes the region's evolving commercial real estate landscape. Eric is an experienced researcher with a deep knowledge of real estate markets and a proven track record of successfully leveraging data to assess industry trends. Eric graduated magna cum laude from Yale University with a Bachelor in Arts in Economics and is a Robert C. Bates Fellow. Eric, thank you so much for being with us here today.
Thank you, Holly, for that introduction, and I'm excited to join you all virtually for this discussion about how COVID-19 is impacting the commercial real estate environment nationally, and then, of course, in our region of Southern California. As Holly mentioned, I work with CBRE, where I lead our research and thought leadership teams for the Pacific Southwest. And our position as the world's largest brokerage firm and the world's largest commercial real estate services firm broadly gives us a unique vantage to observe the changes underway as COVID-19 moves forward and as it impacts the commercial real estate environment. So I'm excited to share our perspective on those trends with you this afternoon. Before I dive in, though, I want to sit a moment with the magnitude of the shift in the way we interact with the built environment around us that COVID-19 has caused over the last 6 months. Shown here is Google mobility trend data, literally tracking the movement of individual cell phones. And in the course of 1 month at the beginning of the pandemic, from March to April, our patterns of daily life changed dramatically. The share of time people spent outside of their homes dropped by a quarter. That's this dark green line on top of the chart, dropping to a quarter. That was largely driven by a decline in people going to work, the light green line, and people shopping at restaurants or shopping at stores or going to restaurants. That's the light blue line. And now, 6 months later, almost 6 months to the day from when many of these social distancing restrictions were first put in place in California, many of those patterns have moderated, but they've persisted. Today, still, we are spending 12% less time outside of the home, and very few people are going to the workplace or going to stores. That's 30% below where we were back in January pre-COVID. And I highlight this to suggest that a change of this magnitude, a forced shift of this magnitude, inevitably has ripple effects on the commercial real estate environment and durable impacts on the commercial real estate environment. And those are the ones that we're starting to see emerge from where we are here in September. The shift has occurred across asset classes. COVID-19 has changed how we work, how we shop, and how we live. Today, I'm going to be speaking with you most about how we work, what the shift in the office place, the workplace has been. That's something we at CBRE spend a lot of time thinking about, and I'm excited to share some research that we've done on that sector. But in addition, we'll talk a little bit about how COVID-19 has changed the retail landscape and the residential landscape, both areas that have been impacted over the last 6 months. So let's dive into the workplace. And it's important to remember that work from home is not a new phenomenon, and the work from home experiment has been something that was growing rapidly before COVID-19. From 2004 to 2018, in those 14 years, the number of employees who worked usually at home grew, it almost doubled, grew by 80%, vastly outpacing the growth in workers in a traditional workplace setting who usually worked at the workplace. That grew by 15%. In the middle was this flex work, where the employees sometimes conducted work at home, sometimes conducted work in the office place, which grew at 38%. All that's to say that a work from home, the adoption of remote work is something that was occurring before COVID-19, but accelerated in dramatic magnitude as a result of the pandemic. And of course, where we sit today, we're still in the midst of this massive work from home adventure, this virtual experience of engaging with the office. CBRE manages several million square feet of real estate throughout greater Los Angeles. And before COVID-19, happened and entered the United States and persisting throughout the pandemic, we've tracked closely actual utilization of the occupancy. So real physical occupancy, foots on the ground, key card swipes, the number of cars in the parking lot, to estimate what actual utilization of the office buildings we manage is. And consistently, since the beginning of the pandemic, less than a fifth of the normal workforce has been entering the offices we manage. It varies a bit by product type. High-rise office currently is 90% below normal, whereas suburban low-rise office, perhaps that doesn't have an elevator or that's easier to access without some of the social distancing challenges that high-rise offices present, has been more like 18 to 20% of normal occupancy. But overall, we're still talking about small numbers, where less than a fifth of the office workforce of Los Angeles has been showing up to work in a physical office environment since COVID-19 has occurred. And of course, all of this is occurring because of the social distancing requirements of the virus and the restrictions that the state of California and municipalities have created. In the midst of this work from home experiment, CBRE embarked on an effort to figure out what the impact will be going forward. How do we expect COVID-19 to impact the office of the future? In order to figure this out, we conducted a survey with 130 corporate real estate executives at large firms that we work with across the globe. These 134 firms represent 20% of the Fortune 100, and roughly half of the surveyed firms were Fortune 500 companies. So broadly speaking, these are large companies with substantial workforces and as a result, also very substantial real estate footprints. And what did we learn? Well, first, we saw that COVID is clearly accelerating a trend towards remote work. In the pre-COVID times, 63% of these companies that were surveyed didn't have remote work as part of their corporate real estate strategy. But there's been a dramatic flip. Today, looking ahead to the future, these same companies report that 70% of them see remote work as in some way, shape, or form being a part of their strategy. And perhaps even more dramatically, only 10% conclusively say that there will be no remote work strategy for their company. And of course, this evolution, this explosion in remote work has pushed companies towards a more fluid workplace model. 61% of companies surveyed in this survey responded that they expect their employees to have some level of optionality in where they work, being able to choose between a workplace that the company rents or leases or owns and their home environment. That's a massive increase. That's a 20 percentage point increase from where these companies were pre-COVID. A really dramatic change in the way companies perceive the use of workspace for their employee base. And the end result of this is that we're seeing that COVID has accelerated a trend towards a hybrid workplace model. If you think to the traditional workplace model, it was hierarchical, and there were corporate users that had discrete but complementary strategies to fulfill their needs. Whereas the workplace of the future is embracing, and this is one that's emerging right now in the COVID times, is embracing a much more networked series of office or working environments, several different workplace modalities that interface and overlap in interesting ways. So let's take, for instance, Joe Worker, an average office worker. In the traditional model, he likely showed up to the same office every day in a week. His office routine was very routinized. And maybe when he moved from one city to another, or he moved from a city to the suburbs, he shifted to a satellite office. But broadly speaking, his pattern shifted with him, where he would show up at the same office, likely the same desk or actual physical office every day. In the new model, the model that we see emerging today as a result of COVID-19 and other trends in the office marketplace, is Joe Worker's routine looks very different. Every day probably is a slightly different model. Maybe one morning he starts work at a cafe before logging into a remote meeting. And then after that, perhaps he goes in the evenings to a flexible working space environment for project meetings or meetings with clients. The office of the future that we see emerging embraces all of these modalities and gives the flexibility to workers and to employers to modulate as they see fit across the needs of a project, a client, or their employee. As a result of this evolution, there's a growing acceptance among corporate real estate executives of flexible workspace solutions. Flexible space is a term we use to broadly describe a range from co-working space to serviced offices, broadly companies like WeWork, Convene, or Hana. And this has always been an element of corporate real estate strategies, but it has been increasing and growing partially as a result of COVID-19. 73% of companies say that moving into the future, flexible space will play at least some role in their corporate real estate strategy. And while many companies have had this flex space as part of their strategy before, 30% say that they are looking to increase their use of flexible space moving forward. Again, to give both the corporation and their employees some level of scalability, some level of flexibility in their working environment. And as a result, by necessity, the physical environment of the workplace is going to look different. Think back to Joe Worker, our average office worker. Before COVID, he likely had an assigned desk or an assigned office in a building. In fact, 58% of the companies we surveyed indicated that they had a mostly assigned workplace environment. However, moving to the future and thinking about the post-COVID workplace, only 18% of companies report that they are looking to have a mostly assigned environment. Instead, many are transitioning to some level of free addressing that gives employees the flexibility to choose where they are sitting, both very concretely, but also to choose where they are locating to do their work at any given time. As we think about the future of the office, many have speculated about the relationship between CBD, dense urban office space, often high-rise office, and the periphery or suburban office, wondering what the relative impact of COVID-19 is on that. And at CBRE, we have yet to see any suburban shift materialize. The data shown here on this slide is from an internal survey of leading office brokers nationally. And as of August, 0% of them, brokers reported seeing any actual leases signed that indicated that companies were shifting workers to the suburbs or creating additional office space in the suburbs to accommodate employee flexibility. And beyond that, on the other side of the ledger, about half said that they are neither having conversations with clients nor do they anticipate having conversations with clients about this suburban shift, that they don't see this as likely to materialize. All in all, the impact of COVID-19 on the workplace looks to be one of accelerating several trends that were present pre-COVID, but have really been supersized in some ways by the pandemic. One of those is remote work. Companies are increasingly looking to remote work as one element of their workplace strategy to give employees the option to work from home at least some period of the work week. Another is fluidity, giving employees some level of flexibility to choose their work environment on an ongoing basis and to adjust as the nature of their work demands. Of course, also is adopting flexible workplace solutions and using flex space as one ingredient in terms of a broader workplace strategy. Collectively, these trends describe an evolution towards a hybrid office place, one that is closer to what the employees of today are demanding. And I think it's important to say, as we speak about office, that despite polemicists that are heralding the end of the office space as a result of COVID-19, the data simply does not support that. When we speak with corporate clients, they continue to embrace the office as a site of corporate collaboration and corporate community, and they see that continuing into the future, even as the pandemic subsides. Now, pivoting to retail, much like office, the pandemic has accelerated several trends that were present before COVID. Most notably, this has been the massive divergence between online retail or e-commerce and traditional brick and mortar retail. You can see here Census Bureau data on monthly retail sales, with the dark green line being, the light green line being non-store retailers, which is traditionally online retailers, and then the dark green line on the bottom being total retail, so everything excluding the online only retail. In the midst of the pandemic, that traditional retail category cratered, dropping 22% through April as a year-over-year number before climbing back. And whereas the most recent data of July, seeing that we're just roughly in line, slightly above 2019 levels, 3% above. In contrast, the e-commerce space, the non-store retailers and the online-only retailers, has been growing markedly for the past decade. And you can see even in January and February, a 10% growth year over year. But the pandemic accelerated that. Moving into April, May, June, July, the year-over-year growth has been consistently between 25% and 30%, for online retailers. And in the midst of this context, the impact for traditional retailers has been that those that embrace omni-channel access to their consumers have been the most successful. And brick and mortar retailers, the doubling or tripling of their online sales volume since the pandemic. Shown here are year-over-year online sales growth for several large retailers. And some, like Best Buy, as I said, saw a 242% growth in their online sales, and then Target and Dick's Sporting Goods seeing a tripling of their online sales growth. All of this is an indicator that moving forward, success for the retail industry clearly looks like an embracing an omni-channel approach, leaning into online sales in addition to brick and mortar sales as a way to reach consumers where they are at and access them at every step of the process. We've also seen a dynamic convergence of retail with other asset classes in the midst of the pandemic, an acceleration of a trend that was present even pre-COVID-19. One of these, for example, is the convergence of retail and industrial, and in particular, this interesting dynamic of retail to industrial conversions. CBRE is tracking 60 projects across the United States that are an actual conversion of former retail space into industrial distribution or fulfillment facilities. There are several here in Southern California, including this case study highlighted here, which was a retail space in Orange County, 100,000 square feet, that the retailer decided had a higher benefit as a fulfillment center than actually as a direct consumer retail store. And the store, as a result, has been adapted and shifted into a different use. Beyond retail to industrial, we see interesting and exciting synergies between retail and other asset classes. Retail and industrial conversions and integrations, retail to multifamily conversions and integrations are all present in the marketplace and suggest a dynamic future for retail moving out of the pandemic. And lastly, let's talk about the changes in the way that we live. As I talked a little bit about at the beginning, COVID-19 has changed the way we interact with residential real estate. People are spending more time at home. In the worst period of the quarantine and social distancing, people were spending 30% more time at home than they were prior to the pandemic. And as a result, as you would expect, some have reconsidered their living arrangements. Research out of the Pew Center, which is shown here on the slides, indicates that 3% of Americans have chosen to move as a result of the coronavirus pandemic, that for reasons of COVID-19 have adjusted their living environment. That's not a massive number, right, 3%, but it is significant. In LA County, that represents about 100,000 households that are choosing to move as a result of the pandemic. More instructive, though, is why they moved and where they moved. Among those who moved because of the coronavirus pandemic, the three largest reasons for why that move occurs were: one, to avoid the risk of getting the virus; two, to be closer to family; or three, because their college environment was closed, that their college campus was closing. And the where they moved to mirrors those sentiments in many ways. And that data is shown on the right side of this slide. 81% moved to either a family or friend's place or to a second home or a vacation home. In many ways, a temporary move to a place that they probably already had access to pre-pandemic. 15%, though, moved to a different independent living environment. You can see here that 9% bought or rented a new home with the intent of living after the period, and 7% bought a new home with the idea being that it was a temporary solution for the duration of the pandemic. And all of this is to suggest that the shift in demand, while significant and substantial, is overwhelmingly a temporary one, that there's a real shift in the demand dynamics for residential space across the US, but it's likely to be one that persists for the duration of the pandemic. And we're already seeing that play out in the real estate fundamentals and the fundamentals of the multifamily market. Shown here are asking rates for Greater Los Angeles and the change since January. Asking rates in the urban core, which roughly describes downtown LA to the west side, to Santa Monica, declined by 4% in the last 9 months. Meanwhile, outside of the urban core, more suburban areas or periphery areas remained roughly constant, roughly steady, decreasing a little bit in March, April, but hovering right around January levels. Of course, some outlying suburban areas have seen demand increase, and Santa Clarita Valley is a great example, where rents since January have climbed by a pretty striking 4%, 4.5% in that period. Zooming out, And thinking back over the last 6 months, the human toll and certainly the economic toll both have been and continue to of the virus have been and continue to be quite substantial. We're seeing very real dislocations in the commercial real estate world, in the commercial real estate market, in terms of how we work, how we shop, and how we live. And across all of these categories, though, the virus does not herald. I think the data clearly shows that the virus does not herald the end of the category. Instead, it suggests a period of really dynamic shifts going forward over the next several months, the next several years, and how we relate to the physical environment of how we work, how we live, and how we shop. And that's it.
Thank you, Eric, for a really interesting presentation of your data and certainly describing these dynamic times. Just a couple of questions. I'm encouraged to hear what you said about the non-demise of the office, and I've heard it speculated that some people think we're going to see more office consumption because of social distancing and space demands, and I'm wondering what you think about that theory.
Yeah, that is something we've been hearing a lot about. And I think in conversations with clients and large corporate real estate users, there's been a mix of short-term, medium-term, and long-term conversations, right? Short-term being about how do we adapt the office space to be safe in the near term before the virus is successfully mitigated or a vaccine is present. The medium term is to the extent that any of this continues, and we think that we're preparing for a future in which there are consistent pandemics, how do we adapt the office space? And then, of course, the long term is a lot of what I described about the long-term viability of multiple modalities of office space. And I think that the jury is still out on the degree to which social distancing shows up in office floor plates. We certainly in the near term, that's an important element of getting people back in the office, but it's unclear that corporations are going to embrace that and see a long-term future where there will be a consistent need to have social distancing in order to maintain a safe working environment.
When you hear from your companies that they want that flexible modality, and do you think that looks like individual co-working spaces for a given company, or does that look like the service providers like a WeWork or some of the others that you mentioned? Which do they want their own, or do they want to be part of larger groups?
Yes, well, we've seen an exciting convergence of these two things, right? And so, for traditional corporate real estate that is leased and managed and owned perhaps by the corporation, there has been a shift in the physical environment to more resemble the structure of a WeWork or a HANA or any of those sorts of products. So that is happening on the one hand, but it's more of a software solution, so to speak, of kind of shifting the way it looks rather than a real structuring solution. But we're also seeing an adoption on a very large scale of flexible space by corporations using third-party providers. Using third-party providers because it gives them a level of flexibility and scalability with their needs. It's not the whole part of their corporate real estate portfolio for most of these users, but it's increasingly becoming a critical element that allows them to scale rapidly growing initiatives or to perhaps access talent in markets where they're not willing to open a major office. So we're seeing both of those elements come to play.
Have you seen companies ready to move forward on making decisions on this? Your chart showed that the actual, completion of deals in suburbs, et cetera, hasn't really come forth yet. Do you think that maybe that has something to do with them holding off on making those ultimate decisions?
Yeah, across the industry, there has been a pullback as people, as investors and occupiers look and take stock of the coronavirus and of the economic impact of the virus. And so certainly there has been a sense of pulling in the reins a bit. All of that is occurring at the same time, though, that major landmark users in New York and San Francisco and in Los Angeles and markets across the United States are saying, we're making a bet on office. We know that this is critical to the future of our company and critical to the future of attracting talent, and we're going to move forward with the office space that we think we need. So we do see companies putting their convictions on the line and saying, this is an important element of our strategy going forward, and we need access to these communities.
This is interesting question. You used the case study of a retail environment converting into fulfillment. Do you see those two uses blending? And maybe there's a fulfillment center that actually has a physical retail outlet?
We do, and we see it in different ways, and maybe combining true retail with true warehouse distribution is going to be a tough marriage to make. But already, many retailers are fulfilling e-commerce orders through their physical plant. Whether it's department stores that are fulfilling e-commerce through the department store at a given mall and then mailing out from there, or smaller mom and pop shops that are doing the fulfillment through their retail outlet. We see all of that occurring across the industry as the industrial and the retail worlds blend together as just different channels with which to access the consumer.
That's great. Well, thank you, Eric, for the time today and sharing the research that CBRE has been doing. We look forward to learning more over time. Thanks for being here.
Thank you so much for having me.